Merrill. Let me go across. We're joined by Christy Mathai, Fund Manager Equity at Quantum AMC, joining us this afternoon. Christy, very good having you. How are you viewing a market like this? What are you finding interesting? Give us a sense.
Yeah, hi. Thanks for having me. So when we look at the market at the current juncture, so clearly, some of the stocks over the past 2 months have clearly become attractive in that sense. So if you were to look at our portfolio and how they stack up, 2, 3 years out in terms of upsides, that is looking definitely better. But on the flip side, you also have this, headwind of input cost across the board being very high. And, some of the crude linked products have moved pretty sharply. So our view is, while we have, this situation is much better compared to last week. There is some ceasefire, etc. But this is a headwind to earnings that you would see in the first half. And, if this prolongs, FY27 earnings could be at risk to some extent. So that is what makes us a bit cautious at the juncture. If you are a long-term investor with, these situations will normalize. So you should possibly be looking to take advantage at this point in time of the prices.
Okay. Therefore, Christy, how are you looking at valuations at this juncture? Give us a sense of that on the Nifty first to start off, and then maybe we'll go sector-wise. Given this West Asian war, what's the kind of impact that you're penciling in with regard to the Nifty FY27 or FY28 for that matter?
Right. So we do not have a view on Nifty as such, but we do have on our portfolio stock. So when we look at our portfolio stock, we do some sort of sensitivity that is crude at, certain prices and what if it prolongs. So there we are, if you were to do that math, there is clearly a hit in terms of EPS that can accrue over the next, couple of years, because there is a rolling effect of FY27 earnings. And to that extent, the valuations sort of across pockets have not corrected. Nifty PE, of course, has come down. It used to be around 22 10-year averages. It's somewhere around 19.4 round. So there is a correction that has happened. But a lot of that is also driven by a substantial portion of the index, such as IT services, such as, banks, trading at a very premium valuation compared to its long term, lower valuation compared to its averages. So that is why, we should not really look at Nifty to get that sense. It has to be more bottom up, because, large component of the index is trading pretty cheap. Some portion could be still expensive from that point at this juncture.
Right. And Christy, talk to us about that a little bit more. So even within the financials, there's PSU versus private versus AMCs versus insurance. Where is it within that financials value chain that you're seeing the most value? And all of them trade at a decent discount versus what they used to trade at. So where is it that the best value is coming out from?
Yeah, so apart from, maybe I'll come to bank in a while, but we find some of these private insurers, especially on the life side, now trading at significant discounts to its long-term averages. There has been certain, developments which is most regulatory in nature. For example, GST correction has to be sort of passed on in some of these fashion. So that has impacted the growth to some extent, the surrender value some time back also. So there was a headwind mostly driven by regulatory aspects, which impacted some of these life insurers. Now we have sort of come to value some of these companies. They are, they have not given any returns over the last 5 years. So from that point of view, the valuations have become pretty attractive in some of these portions. So we are looking fairly closely at life insurers. We do have some allocation, possibly thinking can there be more value. The other opportunity clearly from our side is, of course, the banks. We have seen the credit growth data. It is close to about 15-16%, which is one of the highest that we have seen in several quarters. Even the deposit number sort of inching up. Now there could be a year-end aspect to it, because because of the war, there could be certain working capital loans which would have moved up, or you would have some NBFC moving to banks as opposed to issuing NCDs and so on and so forth. That would have helped. but we think it is pretty healthy. And if some of this were to sustain, we should see that earnings accrual for the banks coming through in the FY27 and possibly FY28. So that is our larger bet. And apart from that, we do have some allocation to, let's say, AMC stocks, which, to our mind is not very attractively valued at this point in time. So that's broadly the financial pack for us, how we are looking at it.
Right. And some of these numbers, the likes of HDFC, ICICI, if at all there could be a negative surprise, where would that come from? Because just having a conversation and not able to figure out if there is a negative surprise, where will that come from? And if so, are we only looking at a slight positive bias to those numbers, if at all? That's the way to think of it?
Yeah, so clearly, I think the street is looking at the margins. It is, and maybe to some extent, at least the credit cost, which has been where it is. So I think the numbers that people are really tracking is the margins at this point in time, because we have seen the growth come through, and possibly the deposit growth also to that extent come through. But we need to look at what cost has this come at. So that is where things are. And of course, possibly we've had a tailwind of trading profits, treasury profits in the first, earlier part of this year. But now some of that is fading. And, if you were to look at the public sector bank, we think that could also be a headwind going ahead, because now slowly what will happen is the credit cost also will normalize. We have had almost 2 to 3 years absolutely credit cost being extremely benign, but when that happens, the ability to price loans at such finer prices, especially by the public sector banks, may be a bit difficult. So that might impact the growth. So that is how we are looking, at these numbers at the juncture.
Okay, interesting. Christy, let's venture into some of the other pockets, especially within the mid and small cap. Say a realty, for example. What's the take there? Say metals. What's the take there? Any interesting buys over there, or has the kind of run up in metals maxed out in terms of the earnings compounding for maybe the next year or so?
Yeah, so realty is a pocket of opportunity for us. So we have been sort of fairly bit deployed in that pocket. We have used the correction that we have had in the past month to deploy into some of those names, because again, we think valuations have clearly sort of bottomed out in some of these packs. And what we have seen over a cycle is, while there could be a temporary slowdown, and some of these larger real estate names which have a cost of fund benefit, there is a benefit in terms of where they could raise money from. So their execution track record sort of really improves, in this consolidation phase within the real estate sector. So we have, we think some of those are trading attractive. So we added to a very well diversified group within the real estate pack. So metal, the prices have really firmed up again. If you were to look at the import issue, which was a problem some time back, what we have found is, the domestic prices are firmed up, and some of these input costs that are required, the freight cost or the input that are required, also are moved up. So to that extent, the pricing is really helping the metals pack at the juncture. So in our view, as long as things continue the way it is, possibly the prices could be where it is. But there is not enough valuation comfort within the metal pack at this juncture. So we do have some exposure, but we may be using this, move to sort of trim or sort of keep our position where it is.
Consumption, Christy?
So within consumption, we do like consumer discretionary as a primarily autos. So the benefit of GST has really sort of helped. If you were to just look at the auto numbers, even the current wholesale numbers, the month gone by has been extremely strong. Clearly now our sense is it is a time for us to be selective within that pocket. So we used to have a very large exposure both in the forms of two-wheelers. We almost owned the top 3 4 two-wheelers that we have. So we have sort of slowly trimmed our allocation there, primarily because we think now the input cost issues might sort of play out, and the valuations have really moved up. So in this pocket, so there could be some sort of softening from our perspective. So we are fair bit allocated to that, but these are some of the headwinds that you might have to look. And the traditional consumption themes that we look at, we are not present there primarily because we think, although, over the past 9 months, there has an improvement in terms of, let's say, the volume growth for some of them. But we still think the valuations are not where it is to justify that sort of 7-8% growth that you see in the pack. We like consumer durables, which had a poor year last year. We think, near term, it was oversold to that extent, just given a couple of seasons which were not pretty good. So now we think that possibly is a place where things can normalize and be better, especially in the durable pocket.
Okay. Christy, always a pleasure speaking with you. Thank you so much for coming in and giving us that perspective.
Thank you.
Okay.